Let's jump right into this explainer and finally decode the whole debt-to-equity ratio puzzle. Think about it. Is corporate debt a massive growth engine or a ticking time bomb waiting to explode?
Well, the DE ratio divides everything a company owes by what it owns, revealing its true financial health.
It's basically a giant financial seesaw. You're balancing risky, borrowed cash right against super stable shareholder investments.
And look, debt isn't always evil. It often acts as high-octane fuel, rapidly accelerating business growth.
But the second the economy dips, those fixed interest payments suddenly transform into a massive financial risk.
Which brings us to the big question. Does high debt automatically mean a company is totally doomed?
Not necessarily. Say you see a ratio of 2.0. That's $2 of debt per dollar of equity. But context is literally everything here. What's considered a normal ratio varies wildly depending on the industry.
You really have to contrast asset-light tech startups with massive, capital-intensive behemoths like airlines or factories.
Big tech uses hardly any debt. They fund their massive growth almost entirely through their own equity.
To put that in perspective, the entire tech sector averaged a super low 0.41 ratio in early 2026.
Now, flip over to utilities and airlines. They actually sit comfortably at a 2.0 ratio or even higher.
How? Because they sell everyday necessities. That generates incredibly stable, recession-proof cash flow to cover the debt. To get a clearer picture, we look at the long-term DE ratio, stripping out short-term daily operational churn.
Long-term debt, like big corporate bonds, really exposes a company's deep financial commitments and true risk appetite.
It's all about the trade-off theory. They're constantly weighing the tax benefits of debt against pure bankruptcy risk.
But hold on, it gets trickier. There are some huge hidden leverage traps you absolutely have to avoid.
You've got to watch out for share buybacks, sneaky off-balance sheet leases, and totally ignoring a company's actual cash flow.
See, share buybacks artificially shrink equity on the balance sheet. That makes the leverage ratio look artificially terrifying. Meanwhile, operating leases act exactly like debt, but companies often manage to hide them off the main books.
And a perfect ratio is totally useless without cash flow. To dig deeper, definitely check out deepvalues.ai community.
A declining ratio shows real strengthening. Also, to track overall market temps, search the Buffett Indicator app on iOS. Remember, DE decodes management's real strategy. Disclaimer though, this explainer isn't financial advice, so always do your own homework.
Look at your own portfolio. Is it built on solid ground or a mountain of debt, like this explainer?